What if the fastest way to get rich is to stop trying to get rich? That sounds crazy. But most investors lose money for one stupid reason. They do too much. They chase hot stocks, they panic sell, they overtrade, they listen to loud people with perfect confidence, and they keep destroying their own returns. The brutal truth is this: you do not need genius to build wealth. You need to avoid the same dumb mistakes everyone else keeps making. If you click away now, you will keep paying for bad decisions. You will keep confusing motion with progress, and you will stay trapped in the investing casino. In this video, I will give you 3 exact frameworks from this book. You will learn why most investing mistakes are really behavior mistakes. You will see why active management usually hurts ordinary investors. You will understand how bad numbers trick smart people into bad decisions. By the end, you will know how to stop sabotaging your own money. You will stop reacting to headlines like a nervous amateur, and you will see how boring investing often wins. This is not about secrets or stock picking magic. This is about building a process that avoids self-inflicted damage. The book we are breaking down today is How Not to Invest. It was written by Barry Ritholtz. He is a longtime market commentator, author, and wealth manager. He also hosts the popular Masters in Business podcast. Why should you listen to him? Because Ritholtz has spent years studying why investors fail. He does not sell fantasy. He studies mistakes. He studies behavior. He studies the gap between what people think they do and what they actually do. His core idea is simple. Most people do not lose money because they are stupid. They lose money because they are emotional, distracted, and overconfident. The first major concept is that bad behavior kills returns. That sounds obvious, but it is the whole game. People buy after prices explode. They sell after prices crash. They chase yesterday's winners. They dump boring winners too early, and they keep paying huge fees for the privilege of underperforming. Ritholtz says the market is not the main problem. You are, or more precisely, your behavior is. A 20% market move can be survivable. A 20% emotional mistake can destroy years. Look at panic selling. One bad month and people bail. Then they miss the recovery. Then they never come back. My honest take? This is the most important investing lesson in the book. Your portfolio is only as good as your discipline. If your emotions run your money is already gone. The second major concept is that bad numbers create bad decisions. People love big, scary, impressive numbers. They hear inflation, debt, or valuation and instantly panic. But Ritholtz shows that numbers without context are traps. A number can be true and still be useless. That is the problem. People look at a stock's past returns and assume the future will copy them. They hear one economic headline and treat it like prophecy. They compare one fund to another without checking fees, risk, or time horizon. That is how bad numbers fool smart people. The book's bigger point is simple. Good investing needs good framing. You have to ask, what does this number actually mean? What is the time frame? What risk is hidden underneath? If you skip those questions, you are not investing. You are just reacting to noise. The third major concept is that simplicity beats complexity. Ritholtz is brutal about active management. He shows that most people do not need stock picking. They need a good plan. They need low fees. They need broad diversification. They need patience. The core portfolio idea is mostly passive indexes with maybe a small satellite layer if you want it. That means the boring stuff is the base, not the exciting stuff, not the speculative stuff, not the I've got a feeling stuff. He is especially hard on people who think they can outsmart the market. Most cannot, and even many who can still fail because they overtrade or get emotional. The real lesson is not be smarter, it is be harder to mess up. That is a huge difference. The less you touch your portfolio, the better your odds usually are. So, what is the best thing about this book? It is honest. It does not flatter you. It tells you that your biggest risk is often your own behavior. That is refreshing. The flaw? At times, the book can feel repetitive, because once you get the point stays the point. Also, some readers who already invest passively may not find many new tactics. This is more a guardrail book than a blueprint book. It saves you from mistakes more than it gives you exotic ideas. Who is it for? If you are a beginner who feels overwhelmed, read this. If you keep buying high and selling low, read this. If you want to stop being your own worst enemy, read this. Here are 3 zero-cost steps to take tomorrow. Step 1. Write down your last 3 investing mistakes. Be honest. Was it fear, greed, or boredom? Step 2. Look at your portfolio and cut one source of noise. That could be a bad newsletter, a hot tip, or a useless app. Step 3. Commit to one boring rule. For example, I buy, rebalance, and leave it alone. That simple rule can save you from years of damage. If you want the free PDF summary, check the description. If this video helped you, buy me a coffee and subscribe.